Hello, this is Myron Mitchell from Mitchell Wealth Management Group. Please take a few moments to watch this brief video and learn how our partnership with Symmetry can help you reach your long-term goals and avoid the common traps in today's markets.
At Symmetry, we're not in the business of speculating, we're in the business of investing. We like to say we're built on research and backed by principle. We're focused on delivering an exceptional investment experience regardless of age, occupation, or asset level. A successful investment experience requires concentration on those things over which you have some control, namely costs, taxes, and perhaps most importantly, risk. Too many investors focus on things over which they have no control, like returns or news. News is, by definition, unpredictable. Yet many investors make decisions because of things like global debt, political instability, or unemployment, issues all out of their control. When you consider a timeline of traumatic events throughout history, events like world conflicts, political scandals, terrorism, or the most recent global recession, you can always find a reason not to invest. Yet we know markets are very resilient, and as economies grow over time, so do markets. We all have emotional ties where our money is concerned. Many of us let emotions rule our financial decisions, especially during volatile times. This can manifest itself in both up and down markets. Quite frankly, it's human nature to buy when times are good and sell when times are difficult. In effect, we buy high and sell low because we like to add to our winners and sell our losers, when we should probably be considering doing just the opposite.
It is often difficult for investors to see how their short-term investment decisions affect their long-term goals. There are several studies that look at the difference between what investors could earn in equity markets and what they actually do earn. You are looking at a well-known study of the average equity fund investor as depicted by Dalbar Incorporated, a Boston-based research firm. The study found that while the S&P 500 produced an annualized return of 7.81% over 20 years, the average equity investor earned only 3.49%. You don't have to know a lot about finance to see the gap between these returns. Why did the average equity fund investor lag so far behind the S&P 500? The answer is largely because we're human. It's in our nature to let our emotions drive our decision-making, and those decisions don't always serve our best long-term interests. One of the most important things you can do is to shut off the noise. Don't be sucked in by the 24-hour nonstop media news cycle, sensationalizing world events. Remember, the media's goal is to keep you watching, listening, or reading. Steve Forbes, the founder of Forbes magazine, once said, "They make more money selling advice than they do actually following it." It's one of the things they count on in the magazine business, along with the short-term memory of their readers. Risk and return are concepts that are fundamentally related. When we mention return, we're talking about the growth of your investments. Risk is your ability to handle the fluctuations in those investments. Many people take on high levels of risk in search of high returns, not taking into consideration the downside implications. Consider the 7.81% annualized return earned by the S&P 500 index over the last 20 years. It sounds pretty good, but you need to think hard about what you have to endure to achieve it. The annual return on the S&P is generally not 7.5%. It's often either higher or lower, sometimes much lower. In 2008, the S&P lost 37% of its value. From 2000 through 2002, it lost money 3 years in a row. First 9%, then 12%, then 22%. Would you realistically be able to hang tight in an investment after losing that kind of money? The 7.81% long-term return is inextricably tied to those losses. It represents the payment you receive for bearing the risk of accepting those losses. Beware the money manager who tells you he will give you the up years and protect you from the down. There's no evidence that most managers can do this consistently. Often, attempts to time the market drain even more from your assets as you get out or back in too late, thus absorbing the downside and missing out on the upside. Symmetry's portfolios aim to reduce risk in two ways. First, we offer a selection of balanced portfolios, and second, through the practice of broad diversification. Our balanced portfolios are designed to cater to many different levels of individual risk tolerance by combining a mix of stocks and bonds. Our goal is to offer a portfolio that's right for your level of risk. At Symmetry, we don't want to just get you in any portfolio. We want you in the right portfolio. We also seek to reduce risk by owning thousands of stocks and bonds from multiple markets, countries, and asset classes around the world, ultimately creating some of the most diversified portfolios in the world. One of the benefits of diversification is that you own a portfolio that's not overly concentrated in any one area, so that when any one security or sector or industry is falling out of favor, it's not causing your entire portfolio to crumble.
An independent financial advisor can help you stay focused on your long-term goals by assisting you with financial planning, portfolio selection, regular communication, and ongoing education. Your advisor can help you become a successful investor by guiding you through times of prosperity, but more importantly, times of uncertainty.
Symmetry gives you an avenue that doesn't run directly through Wall Street's sometimes reckless gambles, but ones that put your interests first. We believe that investors of any age, occupation, or asset level are entitled to an exceptional investment experience. Our model for investing is built on research and backed by principle. We don't make wild guesses with your hard-earned money about what financial markets may or may not do. Instead, we empower investors to turn off the noise and focus on their unique path to success.
Thank you for watching. I hope you found this presentation to be informative. If you have any questions or would like more information, please feel free to contact Mitchell Wealth Management Group at 336-774-6535.